everyone. Thank you for joining us. This is Rosemary Becchi, and I'm running for Congress in the 11th District of New Jersey. I want to thank everybody for joining us this evening for our third virtual roundtable. You know, we've gotten such great response from our other two roundtables that we really wanted to continue to provide this forum to talk about important issues that we're all facing right now. So tonight we're going to talk about the CARES Act. As you know, Congress passed this late last week and the President signed it into law on Friday. And there's a number of provisions in it that small businesses can take advantage of. So we're going to talk about those this evening. But first, before we get started, just a little bit about the technical side of things. Please keep your phones and your computers on mute. If you'd like to ask a question, there's a raise your hand function. You can also ask questions by typing in your question in the chat room. Be sure to put your name and your email address, and we will make sure that we try to get to all of the questions that come in. But as I said, the topic tonight is we're going to talk about the CARES Act and specifically about the provisions that are in it and some of the programs that you might be able to take advantage of. And I'm fortunate to have four of my colleagues with me this evening to join us. I am fortunate enough to work with them on a daily basis. Joining us is Russ Sullivan, who is former Chief of Staff and Tax Counsel to the U.S. Senate Finance Committee. He worked for Chairman Moynihan as well as Chairman Baucus. And when I first met Russ, he worked for Senator Graham of Florida. Also joining us is Harold Hancock, who is a former tax counsel to the House of Representatives Ways and Means Committee. He worked for then Chairman Dave Camp, also worked for Chairman Paul Ryan and Kevin Brady. Also joining us is a senior regulatory and legislative counsel, Radha Mohan. Radha specializes in tax, healthcare, and education issues. And then finally, also joining us is Charlie Iovino, who is also a senior regulatory and legislative counsel and has served as counsel to several Fortune 500 companies. So thank you guys for joining us. Really appreciate you coming on tonight's program and helping us dissect the CARES Act. So let's get started and dig right in. The first thing, I want to just kind of set the groundwork and lay out what the goals were actually for the CARES Act. There were two goals here with respect to the CARES Act. Why don't we flip to the next slide so you can see that. But the goal here was to help workers first and foremost, both help them retain their jobs as well as to provide them with assistance during the pandemic. And the second goal was also to help businesses survive the pandemic. And so this package contains a lot of programs and provision in it that are geared towards helping businesses retain their workforce and stay afloat. So we'll flip through to the next. So the agenda we've got tonight. So the agenda where we're going to start is we're going to start by talking about the liquidity provisions that are contained in the CARE Act. And those are provisions that are intended to give businesses more liquidity through these difficult times. Then we're going to go on and talk about the employee retention provisions. These are provisions that are intended to help and encourage employers to hold on to their workforce. It's also provisions that were intended to help workers through these very difficult times. And then next, we're going to go and talk about the employee benefits provisions that are included, and finally wrap up and talk about some of the miscellaneous tax benefits. So I want to start with talking about the liquidity provisions, and I'm going to turn it over to my colleague, Russ Sullivan, to kind of begin this conversation and talk about the different SBA programs that are contained in the Act. Russ?
Great. So the Small Business Administration has been helping small businesses for many years, but what they are about to implement will be by far the largest challenge they have ever faced. The Small Business Administration has currently about $140 billion in loans out. This legislation authorizes and directs them to issue $350 billion in additional loans. So they are more than about doubling or tripling the size of their portfolio. By far the most significant and widespread program, and probably the most helpful in this entire bill, is the Paycheck Protection Program, which is a loan program to small businesses that it will be very popular because for the first time these loans will be able to be forgiven and essentially converted into grants, provided that most of the proceeds are used to pay the payroll costs for a small business's employees. Now, who is eligible? Well, if a business has ever had a Small Business Act loan currently, in the recent past, they are eligible. But in addition, others are eligible. They added nonprofit organizations, 501c3s, any veterans organizations, certain tribal business concerns, and any company with 500 or fewer employees. And when we say fewer, we mean going down to one. Sole proprietors, independent contractors, self-employed individuals may apply as well. Obviously, they will apply for a much smaller loan than an employer who has a number of employees. So how do we make sure that these are programs and loans that just go to small businesses? What if a small business is owned by a larger business, maybe a big corporation, maybe a private equity firm, maybe some sister affiliated business? Is that small business able to apply? Well, that's a little bit complicated, but generally the SBA has rules that say if one company controls another company, they have more than 50% of the stock, they will be affiliated and they'll have to add all their employees together to see if they have 500 or less and qualify. However, the law did make a couple of exceptions, and you might not be too surprised that two of the industries that they said, we don't care how many employees they have, we want to help them in this loan program, and that's the hospitality restaurant industries. So basically hotels and restaurants qualify regardless of how many employees they have, how many locations they may have. In addition, franchises that are listed under the SBA's franchise directory, they qualify, as well as there's some other exceptions. So there are complicated rules. If your business, if you wonder whether you're actually going to qualify, you're going to have to delve into the SBA rules and some guidance that actually just came out as we started this webinar from the government that's supposed to give us some more details on how these work. So how much can you borrow? Well, they've got $350 billion to lend out. They've set a few parameters. One is the maximum loan, because this is aimed at small business, is $10 million. But they said there's also a more detailed limit, which is any applicant is going to have to calculate what is their 1 month's payroll cost, multiply that times 2.5 to give them at least 2 months or 8 weeks of coverage for their payroll, and then that's how much they can apply for. And now they did include one other rule, which says if you have someone whose compensation is greater than $100,000, you can only count $100,000 toward the payroll costs of that employee that the employer is incurring. So if someone's making $160,000, they only get to count $100,000 toward what's their monthly payroll cost. We have included a little example here. We call it Becky's Coffee Shop, and it gives an example of a small business that has an owner and 6 employees. And as you can see, you take their annual compensation, you convert it into their monthly compensation with the limitation that you can only use $100,000 per year, so $8,333 a month. Add those up, multiply times 2.5, and this coffee shop could apply for $71,665, which should be enough to cover at least 8 weeks of their payroll. Now, what is included in compensation? I'm now on slide 13. It's a broad definition: wages, compensation, bonuses, the taxes that employers pay on their employees, health care contributions, retirement contributions, all included there. And how do you calculate it? Well, you got to go back 12 months from the date of your loan. They expect these loans to be processed pretty quickly, so most people will apply here in early April and will count April 2019 through March 2020 as their 12-month period. So let's say you get approved for a loan, and they promise that virtually everyone will get approved until they run out of money. So what can you spend that money on? Well, you need to spend it mostly on payroll, but they did include a few other things. In addition to the compensation costs we've kind of been going over, you can use the proceeds for rent, utilities, certain mortgage payments, and if you have any other general debt for the business that was incurred before February 15th, you can make interest payments on that as well. So the best part of the program then is what happens next. Is there what we call loan forgiveness? The legislation says yes, there is. And they say the amounts can be used to cover 8 weeks of payroll costs, these mortgage interests, rent, utilities. And if a company uses it for those purposes, then they can have part or even all of the loan forgiven. Now, 75% of the costs must be used for payroll. The other 25% can be used for rent, utility, and these other costs. However, this is aimed at small businesses who are keeping their employees on the payroll and not laying them off or furloughing them. So if an employer does conduct some layoffs or they reduce their compensation, they have to across the board because they are short of cash, then they're going to have some of this loan forgiveness reduced. Based on a formula that's pretty much pro rata with how much reduction their employees get in their paychecks. Now, the terms of the loan are actually extraordinary. The maximum amount that a loan can be given is 10 years, but they've started by saying they're going to make them all for 2 years because they expect most of the companies to get the loans forgiven within a matter of months and to just conclude and close out the loan at that point. The interest rate on the loan is 0.5%, and you don't have to make interest payments for the first 6 months of the loan. There are no fees. There's no requirement that you can't get credit elsewhere. There's no collateral or security. The owner does not have to personally guarantee the loan. It's all federally guaranteed, and that's what's going to make your neighborhood or national bank want to process this loan. To apply, go to your SBA-approved bank. If you've got a bank you regularly deal with, particularly one that processes small business payrolls, that's the bank you want to go to. And they're open to receive applications beginning tomorrow, April 3rd. They will add some other banks, some non-SBA banks, in the coming weeks to try to process what I expect to be an overwhelming rush to get these loans. So you want to get in the queue and you want to get your payroll information ready for the application. Now, there are a couple other. Go ahead.
Russ, I was going to ask you, is there a place where folks can see where there's a sample application? Does that exist anywhere?
They can either go to SBA.gov or to Treasury.gov. Either one of those will have a link to COVID-19 right there on the first page. And there you can get both the application, the instructions for filling it out, and some general information about the program. You can also get a little information about what the banks are getting out of this. They're getting a very low interest rate, but they are getting some origination fees up front that will entice them to participate. All right. There are other things that are included in this bill. I'm going to mention them very briefly. There's an economic energy disaster loan provision. These have been around for a long time at the SBA, but the CARES Act provides an additional $10 billion in funds to make these loans and grants, similarly structured to what we've talked about on the Paycheck Protection Program. You can get as much as $10,000 in 3 days and can apply for a larger amount and can fold that into your application for your PPP loan if you'd like. For those who already have a loan, you can either apply for a new one and roll it into it, or you actually can take some relief and defer making some payments for a period of time. It's probably like 6 months where you don't have to pay any interest, principals, or fees. This is going to be available for a number of folks who have current loans. So those are the SBA provisions.
Great. Well, thank you, Russ. So we're going to move on to slide number 22. So this is another opportunity to provide some liquidity for employers. And basically what this is a deferral on the payroll taxes. And this is a provision that's provided for in the Act. And more specifically, what this does, it allows you to defer the employer portion of the OASDI, meaning the Old Age Survivor and Disability Insurance portion of the employment taxes. It also allows you, if you're self-employed, to defer the 50% of the OASDI portion of the self-employed taxes. Go to the next. And one more. And so the deferral is pretty generous here. Basically, that you get to do this deferral of the payroll taxes. You can defer it 50% until December 31st, 2021. And then the second deferral is through December 31st, 2022. And no interest is owed on the deferral. So this is a very generous provision. So we've got another example that you can take a look at, and it shows exactly how the deferral works. But if you've got April 2020 wages that are subject to OASDI in the amount of $28,666, the employer share is the 6.2%, which leaves you with $1,777. With a 9-month deferral, it provides you with a total deferral of almost $16,000, and you get an interest-free loan of $8,000 per year. Neither payment needs to be made until, as I said before, December 31st of 2021 and 2022. So that's another way of providing the liquidity. Russ, do you want to next talk about the Main Street Fund for businesses that are over 500 employees?
Sure. So for larger businesses, there's a separate program where Congress authorized nearly $500 billion for a fund that is going to be aimed at giving loans to larger businesses. These are not near as attractive as the small business loans because A, they'll have to be secured, B, there's no forgiveness of the loan, and there's a higher interest rate than the 0.5%. Nevertheless, this will be the major area for larger companies to pursue. It's going to be jointly financed by the Treasury Department and by the Federal Reserve, who's going to throw in $1 trillion or $2 or $2 trillion, up to $2 trillion into this fund. So in effect, it will actually have a couple of $1 trillion available for loans. The loans will be made by private sector banks. It's going to be organized by the Fed Bank in New York City, but there'll be banks all across the country offering these loans. However, these loans have some significant strings attached. So if you're working with or work at or own a larger company, you have to understand the limitations here. If you decide to take one of these loans, you can't buy back your stock for the life of the loan plus 12 years. Same with dividends. You can't issue dividends. And there are executive compensation limitations. Anyone making over $425,000 can't increase their salary, that compensation amount during the term of the loan. These loans are going to vary in number of years. Some of them may be a few years. They don't expect any of them to be really long term, but they will be a number of years. There may be additional strings attached when they come out with the details of this, which they have not yet. It's not clear whether the government's going to focus on the lowest risk borrowers, the companies that have the best rating by investment companies, or whether they're going to be broadly available throughout the country to mid-size and large firms. But if you're a small business, you're technically eligible, but our sense is that you're going to be directed to this small business program, and you're not going to get approved unless they end up with a lot of money left over at the end.
Got it, Russ. Thank you. So we've got one question that's come in, and it's come in from Pam. Hi, Pam. And the question is, can you please put up an example of the PPP application? Is this referred to as the Section 7A? The answer to that is yes, it is referred to as the Section 7A program, and we can certainly direct you to where the sample application is on the website. I do know that one exists on the SBA website. Russ, I think you also said there's one on Treasury's website as well.
That's right, and it is just a 2-page application with 2 pages of instructions. So it's fairly simple, a lot of check the box. You have to include your payroll and then multiply it by the 2.5 and tell how many employees you have. You have to disclose any owners that have more than 20% and just make 5 or 6 certifications in order to complete the loan.
Great. So here's the next question. We're going to answer a few here before we go on to the employee retention programs. But the next question is, can a small business apply for both an emergency disaster relief loan and a PPP? I keep calling them P3 loans. So the answer to that is yes. You can apply for both. You can apply for the Economic Injury Disaster Loan Program and then roll it into the P3 loan program.
The only caveat to that, Rosemary, is you cannot get forgiveness from the EIDL loan if you get the PPP loan. So that PPP loan sets the maximum amount at the 2.5%, 2.5 times your monthly payroll.
Okay, great. And then the next question is, do you have to apply for the payroll tax deferral or does it happen automatically? The answer to that is that you don't apply for it. You just as you're filing your 941, you just make the adjustments there in the filing of your taxes. Because you remember, you still need to submit other payroll taxes. It's just the OASBI portion that you're not remitting at this time. Great. Well, we can move on from here. The next section that we were going to talk about is the employee retention program. Move on to the next slide. And first and foremost here, what Congress has created is a refundable tax credit, and it's up to 50% of $10,000 in wages, which is a very generous credit. And the hope here is that it encourages employers to retain their workforce. The qualified wages don't include any wages paid under the new FMLA tax credit program or the paid sick leave program. So who is eligible for this? Any employer carrying on a trade or business during the calendar year is eligible for this. However, they need to have their trade or business has to have been fully or partially suspended, or they've seen some kind of dip in their gross receipts. There are specific wages that are qualified for the retention tax credit, and the rules differ slightly with respect to whether or not you've got more than 100 employees or less than 100 employees. And then probably the biggest thing to point out here that with respect to the SBA Paycheck Protection Program and the Employee Retention Tax Credit is that if you receive a loan under the PPP3 program, then you are not eligible for the Employee Retention Tax Credit. You need to choose between one or the other. Going to move on.
Rosemary, from a strategic perspective, almost everyone's going to find the PPP program to be more beneficial than the retention tax credit. But the retention tax credit's available for all companies, including those who are over 500 employees.
Right. Rada, do you want to talk about the short-term compensation arrangements?
Sure, happy to. So the short-time compensation program is something that some of you might be familiar with. They are also known as work sharing or shared work arrangements. What the short-time compensation arrangement allows you to do is reduce hours of work for your employees as opposed to laying them off. Some of your workers can continue on a full-time schedule. You can furlough some of your workers, and then you can keep some of your workers on a reduced hour arrangement. Those employees that are experiencing a reduction in their hours are allowed to collect a certain percentage of their unemployment compensation benefits to replace a portion of their lost wages. So from the employee's perspective, they may not be made completely whole, but at least a portion of their reduced wages will be made up for by state unemployment benefits. For the employer, it provides the added advantage of having the state supplement what you're paying your employee, and it helps the employer by reducing their obligation in terms of compensation due. New Jersey actually does have a shared or short-time compensation program in effect right now. If you see the map on slide 35, you'll see that New Jersey is one of 26 states with a short-time compensation arrangement. It was enacted in 2014, and workers under the New Jersey program are able to retain their health insurance and retirement benefits, and they're also able to continue to maintain their job skills. In terms of eligibility, all employers, regardless of size, who have applied to their state's short-time compensation program and have had their arrangement approved are eligible to participate. The one thing that I will note as a practical consideration is if you do not currently participate in a short-time compensation arrangement, you will have to fill out some paperwork and make sure that your arrangement is approved by the state. For employees, eligible individuals include those who are unemployed or who are partially unemployed, or who are unable to work or who are only able to work part-time as a result of a reduction in hours due to the pandemic. One of the major things to note over here is that in order to qualify, employees need to have had their hours reduced by at least 10%, but not more than 60%. There are states that impose additional requirements in terms of the reduction of hours as well, but this is the general standard. If your employers are able to telework and cannot physically report to work, there may be additional requirements imposed under a short-time compensation arrangement. In terms of how the compensation actually works, employees are basically all the employer needs to do is pay the employee for the reduced number of hours that the employee is working. So for example, if you do a 20% reduction in the number of hours that your employee is working, you would pay that, you would reduce the compensation that you pay to that employee by 20%. The state UI benefit would pick up a certain percentage of the compensation to make the to fill the gap for the employee. Every state has a different calculation of the unemployment benefit amount, and New Jersey's applicable compensation amount would apply to your employee if your employee is in fact, if your business is in fact located in New Jersey. Rosemary, do you want me to cover unemployment compensation benefits as well, or did you want to go over an example?
Why don't we go on to the unemployment benefits, and then we'll come back to a couple questions we've gotten in the interim.
Sounds great. So regular unemployment benefits are also available or have been expanded under the Pandemic Unemployment Assistance Program. The centerpiece of this program is essentially an additional $600 a week payment that runs all the way through July 31st. The most important thing to note about this payment is that even if your employee earns under $600, they are still entitled to their state benefit amount and then an additional $600 plus up under the Pandemic Unemployment Assistance Program. The other two main benefits of the program is that unemployment compensation will now run for 39 weeks, and most states have a 1-week waiting period in place where after you are furloughed or laid off, you have to wait 1 week in order to begin collecting benefits. The federal government has provided funding to all states to waive that waiting period. As a practical matter, it may take a while for unemployment compensation to for the applications to actually be processed. Most states have been inundated with applications, and many are waiting for regulatory guidance from the federal government before taking action.
Great, thank you, Radha. So we've gotten a couple questions. The first one, Russ, and this may be back to you. The question is, I have laid off most of my employees. They have filed for unemployment. I plan to apply for loans tomorrow. How does this affect the loan eligibility? I would be happy to bring them all back and start paying them again.
Actually, the statute does provide that is a possibility, and so you could actually apply for the loan based on your prior 12 months, and then if you get the loan, you can bring them back, as long as you bring them back by, Harold, help me, it'd be April the 27th, I believe. It's 30 days from when the bill was signed. If you brought them back by April 26th or 27th, then you could keep the loan and you could actually get forgiveness for the loan, considering you're paying them for those next 8 weeks without any sort of penalty. If, however, you don't bring them all back, then your loan forgiveness is going to be reduced.
Okay. And let's see, next question we've gotten is there any conversation of expanding the June 30, 2020 for employers that businesses are not going to have the ability to hire back their employers by this hard deadline, or customers
Yep.
are canceling, our customers are canceling events through July now, which would prohibit us from hiring people back?
Yes.
Do you think there's going to be stability here, Russ, in this state?
I think it depends on how this pandemic evolves and when we sort of crest in terms of the number of people infected and who are succumbing to the virus. If it continues on as it has been these last couple of weeks, I think there's a strong chance that Congress will come back in late April or May and say, okay, we provided 8 weeks of benefits, but this is going to last 4 months instead of 2 months. So we need to extend and allow the people who got a loan the first time to get another forgivable loan for the next few weeks. That I think there's a strong chance that that will be considered and happen. They also might modify the rules to expand it to entities that they make a good case they should have gotten one, but the rules held them ineligible this first round.
Okay. And then there's one more question. Does a small business need to show evidence of hardship in making payroll, or will loans be processed just on the request and with the submission of the year's worth of payroll reports?
You do have to make a certification, and it reads, current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant. That's really as far as you have to go. I think under the law, most companies can easily make that certification. It does not say you have to have the loan in order to make your next payroll payment or anything along those lines.
Okay, thank you. So Charlie, we're going to go to you and want to talk about paid sick leave and paid FMLA.
Okay, ready to go. The paid sick leave and enhanced paid FMLA leave were both actually added in the second stimulus package, and they have been slightly clarified in the package that was just signed last week. So for small, these all apply to employers with fewer than 500 workers. First of all, you are, as an employer, required to provide 80 hours of paid sick leave, which would be the equivalent of 2 weeks or 10 days for full-time employers, and part-time employees also would have a 2-week work period of sick leave provided. It applies to employees regardless of the length of their employment by the employer. And if your worker is either subject to a state, federal, or local quarantine, or is self-quarantining, or actually has the coronavirus or is seeking a medical diagnosis of such virus, the amount that is required to be paid is $511 per day for the 10 days. If, on the other hand, your employee is unable to be at work because they are either caring for an individual who is quarantined or caring for a child under the age of 18 due to a school or daycare closure, they are entitled to sick pay leave of $200 a day for the 10-day period. For businesses that are very small, that would be fewer than 50 employees, the Secretary of Labor has some ability to exempt these businesses from paying the paid sick leave if the viability of their business is jeopardized because the employees are actually caring for their child due to a school or daycare closure. However, if sick leave does need to be provided for employees who are actually ill or caring for someone who is ill, the benefit here to the employer is that the paid sick leave will actually allow the employer to claim a 100% refundable payroll tax credit, and that is the employer portion of OASDI, which is the 6.2%. And again, the credit goes up to the $511 a day for the 2 weeks, or the $200 a day for the employees who are unable to work because they're caring for a quarantined individual or caring for a child. If, in fact, you have amounts owed back to the employer above the amount that as the actual liability, they can be refunded directly by the IRS through a check. Both the paid sick leave and the paid FMLA leave begin on April 1st. That was 2 days ago yesterday on Wednesday, because it was effective 15 days. Actually, the Secretary moved it back 1 day, so 14 days after the law was signed. And these provisions sunset on December 31st of 2020. Moving over to the Paid Family Medical Leave Act enhanced benefit, those apply also to employers who have fewer than 500 workers, and the paid leave is for a period of up to 12 weeks. But the first 2 weeks of the paid FMLA leave will actually run concurrently with the paid sick leave. So the first 2 weeks you're getting paid because of the paid sick leave, and the remaining 10 weeks you would get paid under the enhanced FMLA. Employees for this category of assistance actually will have had to have worked for the employer for at least 30 calendar days. And this is restricted and this benefit only applies for those employees who are not able to work because they are caring for a child, again, under the age of 18, because of a school or daycare closure. There is a similar very small business exception that the Secretary of Labor can exempt. And if you lay off an employee on or after March 1st, and then you subsequently rehire them, they can actually be entitled to the enhanced FMLA paid leave once they have worked for the employer on the second hire for at least 30 of the previous 60 calendar days. Again, the payroll tax credit for this enhanced FMLA paid leave is 100% refundable, and it coordinates with the amount of the paid leave, so it is up to $200 per day or $10,000 annually, which is doing the math, figuring out folks up to 500 employees. And again, this is with respect to the employer share of OASBI, the 6.2%.
Great. Thank you, Charlie. So I'm going to take a couple more questions here before we talk about some of the employee benefits that are provided in the Act. Rod, I think this one might be for you. It says, can you give examples for who would be eligible for the pandemic unemployment assistance? Would it include hairdressers, housekeepers?
Yes, it would. Honestly, there are a very long list of people who would qualify for pandemic assistance under this program. It is really anyone who has been directly impacted by COVID-19. So this includes, but is not limited to, individuals who've been diagnosed with COVID-19. If someone in your family has COVID-19 and you're unable to go to work because you are now also required to quarantine, if you're providing care for someone who has COVID-19 and you can't go to work, if your child or someone else in your household for whom you are the primary caregiver is unable to attend school or another facility due to COVID-19, if your place of unemployment is closed, or if you're simply unable to reach work as a result of a quarantine imposed due to COVID-19. And, it also leaves room in there for other scenarios related to the virus as well. So if you've had to quit your job or close your place of employment, due to the pandemic, you should qualify. So the hairdresser example is perfect. In most states, hairdressers are not considered essential employees, so they often have to close their doors during the duration of a shelter-in-place order. So if you have closed shop and you have those who are now, you are unemployed, or those who work for you are now unemployed, you should be eligible to collect unemployment assistance.
And here's a great follow-up question. It's, can a business owner apply for UI regardless of percentage of ownership?
That is a really good question, and I think
the business owner cannot apply. It's really got to be applied by the individual who is laid off. Isn't that correct, Rhonda?
It would be the individual who's laid off, Russ. I guess there are special rules for those who are self-employed or who own their own business. But yes, you're right.
Okay.
Right. Okay, I'm going to take one more here. This is probably a good one for you, Russ. It says, I have my application filled out from treasury.com. Now what? The banks know nothing yet. I was on hold for 2 hours today with TD Bank. They do not have any guidance what to do with this application. Any idea when the banks are going to have a clue?
They are going to have a clue tomorrow, because they'll have a lot of people who decide that they won't have social distancing to get their loan in. Obviously, the banks, many of them are on reduced hours, but if you can't get through, I would take the loan down, the document down to the bank. They may tell you, oh, we're doing this all online. Well, great. Then say, I'm actually prepared to sit down and to send it to the right place now while I'm here at the bank. So what is that address? Let me know where to do that.
Yeah. Yes. Okay, so we're going to move on to slide 55 and talk about some of the benefits that are provided for employees, and in particular with respect to the defined contribution plans. One of the things that the Act does is allow for early distributions, hardship withdrawals from your defined contribution, your 401k plan. It also allows you to pay back those monies over a period of time so that you don't lose those benefits. This provision is specific for just the COVID-19, and therefore it is only applicable with regards to distributions or withdrawals that are made during this calendar year. It also increases the amount of a loan that you can get out of your 401k plan, increases the maximum from the $50,000 previously up to $100,000. But remember, that's a maximum of $100,000 or the participant's vested account balance. So it's the lesser of those two. Again, this is applicable for this year only. And then another benefit that is provided in the Act is that it allows for employers to make payments of both principal and interest on student loans without that being counted as income to the employee. So that's an added benefit. The limitation on this is they can make contributions up to $5,250. And then we're going to move on right now and talk next about just a couple miscellaneous tax provisions that are included that may be of interest to you, to your businesses, or to you individually. Russ, do you want to talk about those couple?
Sure. So there are a few provisions for businesses where if you actually have some sort of a refund that you're due, but it's due in the future, that you can accelerate getting that. And certain payments that you may be due, you can defer making those. One of the deferrals we've already talked about, which is the payroll tax deferral. But if your company has a net operating loss in either 2018, 2019, or 2020, you now can carry that loss back to a year up to 5 years ago. And if you paid taxes 5 years ago on those profits, you can get those taxes back. It's a concept of averaging losses and gains, and if your losses offset your gains, then you shouldn't have had to pay income tax anyway, because over the 5-year period you didn't have profits. This is a change from current law, which only allows you to carry those losses forward. There's also a rule that on individuals and pass-throughs, there was a limitation of $250,000 for individuals, $500,000 for couples on losses for 2020. That has now been suspended, so that if a pass-through entity has significant losses in 2020, they'll be able to use those or, again, carry them backwards or forwards as net operating losses. Second, the current law does limit the amount of interest expense. So if you're part of a business that is highly leveraged, you can only deduct your interest expense up to 30% of your adjusted taxable income for the company. This provision is going to increase that to 50% for both 2019 and 2020. So if you hadn't filed your taxes yet for your business, your corporation, you can get a little more interest expense deduction for that year. It makes other adjustments too. Finally, there's a provision called qualified improvement property, where, guess what? Congress made a mistake in drafting the TCJA in 2017, and they, instead of actually giving taxpayers expensing of non-residential internal improvements, like, for example, the new ordering kiosks that are popping up at McDonald's and Taco Bell and other places to eat, you can write them off immediately, is what they intended to do, but they ended up drafting it wrong, and you had to depreciate those over 39 years. This fixes that provision, and so taxpayers who incurred those costs can get a refund quickly. That's it,
Great.
Rosemary.
Well, thank you. So a couple kind of last questions for you all. You know, and in terms of what's next, obviously Congress has passed this act. It's intended to provide some liquidity to our businesses and to help workers through these difficult times. Do you anticipate that there'll be more to come in terms of relief and help? And what might that look like?
Well, this is Russ. I'll start. I do think there'll be another bill, and I think it will be less focused on the employee benefits and helping the small businesses survive, although, again, it might include an extension of some of these programs. But instead, I think it's going to move on to provisions that will help in a recovery after the pandemic ends. There'll be maybe a big infrastructure bill that authorizes construction projects, both tangible, highways, ports, bridges, that kind of thing, but maybe even intangible, having to do with broadband and the new kinds of online learning that all of our kids have had to learn over these past couple of weeks. So there may be a number of things aimed at spurring business after the pandemic ends.
And Rosemary, this is Charlie. I also think as they were negotiating in Congress, and the lead on this last CARES bill was primarily in the Senate, but Speaker Pelosi became very frustrated, and she put out her own bill, which was much more aggressive. So there may even be some clean energy provisions included in the next draft, with Russ's suggestion of a broader view of infrastructure.
Great. Well, thank you all for joining us. We are at the top of the hour. If there's any questions that any of our participants have, please feel free to email us at info@Becchi4Congress, and we will certainly do everything we can to help find you answers. And again, I want to thank our panelists for joining us this evening and providing all this very useful information. As I said before, these are very difficult and unprecedented times, and I know I've certainly spoken to quite a few people that are trying to navigate this, and it's very difficult and very challenging times. So I want to wish everybody well and to be well, and we will talk soon. Thank you.